Okay, so welcome back to 529. Today is lecture number 5. And today we will put different financial frictions at work and we contrast them how they will work. And so it's an extension of what we did last time. Last time we had a setting where we could fire sell some assets, some physical assets, the machines, physical capital, but we could only issue debt. Well, that was the only thing we could issue. Now we will generalize that. So that's essentially how it falls into the whole class of the models. We're still doing real models, no nominal models yet, no money models. But we went into a setting where we have endogenous risk dynamics, and also the price of risk was endogenously moving around. And we did last time, we did a log utility model with fire sales going on, because firms could not issue out equity. They could not risk share. They can issue debt, but they don't want to lever up too much because it gets too risky for them. Now we contrasted with more financial frictions. Now we said, you can issue some outside equity, but you might also face a leverage constraint. And we show how this whole thing's interplays. So here's the new setting. So it's the same setting like before, just a little bit more involved. So we still have these two sectors, the export sector and the household sector. And the export sector holds a fraction kappa E, which sometimes later on we'll just call kappa, hold a fraction kappa of the capital, and a fraction kappa H are held by the households. Of course, both kappas add up to 100%. The experts, they can issue debt, and that's held by the households. And now they can also issue outside equity, something risky, and that's also held by the households. Okay. All experts are the same and all households are the same, but there are two constraints. There are three constraints. First of all, the physical capital, the households can hold some physical capital, are less productive, but you can't go short physical capital. Or physical capital, you cannot go short. You can go short financial claims, but you cannot go short physical machines or trees or whatever. So that's the first constraint here. So both constraints are up to 100%. And then we have a constraint, how much of this outside equity you can issue. So we argue the amount of outside equity you can issue is limited. You can sell off only a fraction of your risk. You can only sell off at most, you have to hold at least a fraction alpha of the risk you have to hold at your own. Fraction 1 minus alpha you can sell off. So you have some risky machines that produce some risky output. You can issue some risky outside equity, which allows you to share risk with the household sector, but you have to have some skin in the game constraint, which means you can only, let's say, sell off 60%, 40% you have to hold on your own. Okay. So that's a skin in the game constraint. So how much outside equity you can sell off is smaller than 1 minus alpha, the capital share you have on the total, on the whole total capital. And then we also introduce a leverage constraint. That's typically what the traditional macrofinance literature did, like Kiyotaki Moore, BGG, they have a leverage constraint. You can only issue debt anyway, but how much you can issue is limited by this leverage constraint. So Q times K is the total value of all the machines, all the physical capital. A fraction kappa is held by the experts. And you can only issue debt a fraction L of this script L, that's the leverage constraint. So we have these two constraints. So we have three constraints. Essentially, we are playing around. You cannot hold negative households. Nobody can hold negative capital, but this constraint also is there for the experts, but it never is binding. So we can just throw it out of the window and ignore it. But then you have two more constraints, how much debt you can issue and how much equity you can issue, outside equity. What's the difference with inside equity and outside equity? Inside equity is this net worth here. Inside equity is the guy who runs the physical firm. Okay, that's the inside equity holder, the CEO, the owner of the firm who runs it. Outside equity has the same risk than inside equity, but might have a different return. Okay, we will see this later on. Okay, and that's held. This should be labeled also. That's the outside equity issued by the expert sector. Okay, so that's how it falls in the frictions. So we have now incubate markets as before. We have but it's less incomplete. So we can move in this brown region here. We cannot move beyond that. And then there could be a constraint. This constraint actually can go, you can issue debt. So far we said, oh, there's no leverage constraint. You can walk anywhere along this payoff line because it's a bond payoff line. But now you can only move up to here. So this border doesn't have to be exactly here. It can be here. Okay. And so that's the constraint we impose as well. So if there's incomplete markets, but now it's not so incomplete, you can sell some of it off, but not only a limited quantity of the risk. So that relaxes that. So it's not that you can only move along this red line. You can move in this brown space here, but you can't cover this, what is this, blue space. And you can, move to a certain limit. There's a leverage constraint. We have a collateral constraint in this form later on. Okay, so putting everything together, that's a similar slide we had all the time, so I won't walk you through that. So there is the export sector, they have some productivity AE, and the households are less productive, so AH is smaller than AE, okay? And otherwise, it's always the same we had last time. We still go with log utility. Next time, we get rid of log utility, okay? We do constant relative risk aversion, perhaps absence in later on. But then now what's new today is we have a leverage constraint and the theta E debt, so D stands for debt, has to be smaller than the total capital holding of this firm times this multiple, which is smaller than 1, this L script L. And it's occasionally binding, okay? It doesn't need to bind all the time. Why is there a minus sign here? Exactly. So this theta is always, it's positive holding. If you're shorted, this theta is negative minus, and minus, then it becomes a positive number here. Okay. So the thetas, the way we specify the portfolio, is always long positions. So if it's on the liability side, it's a negative number. And that's the same thing for the outside equity. For the experts, it's a negative number. For the households, it's a positive number. Okay. And that's how much you can sell off. Okay, you can only sell off less than 1 minus alpha of your capital holding. Okay, so these are the two constraints we play with, and then we walk through this 5-step approach again, and then we, have the finance block. Today we will mostly live, so we always postulate aggregates that this is the same. So we will focus today primarily on the finance block. Okay. Then this with log utility is not relevant. The evolution of eta is the same as last. So the forward equation and the backwards equation is the same as last time. So I will just borrow it from last time. The finance block will be a little bit more involved because we have all these different constraints floating around. So we have to be careful about that. But it's a lot, it's some repetition from last time as well. So this allows us to go over these tools again, what we did last time as well. So there are different approaches. The first one is to do this portfolio optimization approach, the theta. So each agent is optimizing the experts optimize the portfolio thetas, and households optimize the portfolio thetas. Within this first approach, we can do the stochastic maximum principle approach. We can do the HJB approach, but I will do the stochastic maximum principle approach today. And we can also do the martingale approach. I will also outline the martingale approach, but without the leverage constraint setting in this martingale approach. And then the second approach is this price-taking social planner approach, where instead of maximizing over the thetas, we maximize over the allocation, the capital allocation and the risk allocation. Okay, and we will go over this again in more detail, so we will understand what the difference is. You can go either way, though. You can choose which approach you prefer, and I will give you a hint. When is what approach easier to handle, but in principle, you can go both ways. Okay, so let's go into it. We go to stochastic maximum principle. Yes. Okay, so we have the experts portfolio choice, theta choice, and we have the households portfolio choice. And let me introduce today a simplified notation. So the expected return for the experts for asset J is just REJ. So otherwise I don't get this stuff in one line. So I use a different notation today. It's just the expected return. If there's DR, then it's with the stochastic component. Without a D, it's just the expected component. It's just a drift component. Okay. So everybody is maximizing, all the experts are maximizing their flow utility, discounted as rho E. They're maximizing over consumption, the investment rate iota, how many more physical capital do you want to produce out of consumption goods, and the portfolio choice. They have to say, okay, how much they have to choose the physical capital stock, how much they have to choose the outside equity, and also how much debt they issue. But of course, if you choose 2 out of 3, then the third one is also because portfolio shares add up to 1. Okay. The budget constraint is the net worth of the experts if the consumer goes down. And I wrote it now this way. And then you get on the net worth, you get your interest rate. That's the risk-free rate. And if you invest in capital, you get the excess return on capital. The return on capital depends on the investment rate. Remember, if you invest in investment rate, you get fewer apples, but you get a bigger capital growth rate. That's this iota showing up here. And in the outside equity, you also get excess return. Typically for the experts, this outside equity is a negative number. So this theta E outside equity is negative. That's the expected change in net worth. And then there's the volatility in net worth, which is the net worth times the portfolio. So the risk is on the physical capital and it is on the outside equity. And the risk is the same on both. It is the K risk and the Q risk. Why is this additive? Product rule, Ito product rule, K times Q, K risk, sigma, plus Q risk, sigma Q. This is just an exogenous node subscript T, so it doesn't move around. This can move around over time. Okay, that's why there's a subscript T here. And then we have 2 skin in the game, although we have 2 constraints. One is the skin in the game constraint. That's what we have derived before. So you have, that's the risk you have. And so you have theta EK plus theta OE, and that has to be larger than alpha theta or theta EK, which are brought to the other side. So this is just the skin in the game constraint. And then there's the leverage constraint. The leverage constraint is this one. So you can issue some outside equity, but beyond what you issue in outside equity, you can only issue so much debt. So that's the leverage constraint. So this follows from the earlier constraints we have just translated in the portfolio shares here. If I go back, there's just translated this, and this, I have replaced this D, like the debt. I have to replace what the debt is. So the debt is, if what is the debt is this guy minus this guy to get the debt level here. Okay. So this is that's the problem of the experts. And then I use the Hamiltonian, and the Hamiltonian is always the flow utility, and then have the co-state variable, which is my SDF. So the co-state variable times the arithmetic drift of the net worth. That's just this guy here. That's why I wrote it this way. So that's the arithmetic drift of the net worth. And then I have the other co-state variable, which is plus sigma xi. No, that was the volatility of the co-state variable of the SDF. But I can write it as price of risk. And because it's the arithmetic thing, there's this xi here times the volatility, arithmetic volatility of the net worth. Okay, and that's just this guy here. So that's my Hamiltonian, and then I have this two Lagrange, or this 2 constraints with the Lagrange multipliers, the skin in the game constraint. Oh, sorry, this is a leverage constraint comes here, and the skin in the game constraint comes here. And the Lagrange multiplier for the leverage constraint I call lambda L, what is leverage, and there's a typo, this should be chi. I call the skin in the game lambda chi. I changed the notation. Okay. So if we stare at this, 2 things jump at you, no? So this is just the Hamiltonian, then you have to take the first order condition with that. But if you stare at this, you notice first, this is all linear in thetas, okay? So first of all, the thetas don't show up here. The consumption shows up here. Consumption is hidden in the SDF here. but the theta choice is only showing up in these things, and I can actually divide through this nc. If I do that, you know, the thetas, I get the theta terms totally separately. Do you see that? So consumption and the theta choice are totally decoupled or separate. That's the Fisher separation theorem. Do you see that? Then the consumption choice is here. It might be in the C, and it is in here, but where the thetas show up, there are always the thetas. There's always this C in front of it. But you know, the theta choice is not affected by the consumption choice or by the C. Do you see? That's the Fisher separation theorem. The Fisher separation theorem is I can separately maximize my consumption smoothing over time, and my portfolio choice, what assets I invest. These are two separate. I can separate this. There's no coupling of these first order conditions. Okay. Similarly, there's also Fisher separation theorem with respect to iota. So this iota only shows up here, this Tobin's Q thing. We always did this separately. You know, this was a static choice anyway. It didn't interact with anything else. So we have these three things: consumption, portfolio, and investment. These are three separate things that keeps the whole thing very tractable. Or we can use the so the problem is you have to be very careful with the mathematical method to keep track of all the constraints. I will do the mathematical method just afterwards. I know you can't wait for the mathematical method. I just do the stochastic maximum principle method for a change. So that's the expert's choice. So that's what the experts face. And you see here two things. Things can be solved, the portfolio can be solved separate from consumption smoothing and also separate from iota. Of course, the iota choice will affect the return here, and then it will affect the portfolio choice, but it doesn't interact with the consumption choice. And I have this lambdas floating around if I do this. Okay, so that's the expert's portfolio choice. And then I have to do the same thing for the households. For the households, a little bit simpler because that's their choice. And I can write the same thing. I can walk you, these are the same, just the same thing, just with superscript H instead of E. Yeah. Yes. No, actually there's, so the preferences only end up here. Yes. So what happens, what if this U, if there's a theta term showing up within, so it could be if you have some money utility function, things like that, then you have to be more careful. It could also be with certain specification of cash in advance, you know, requirements, constraints. Then you have to be more careful on these things. But it depends really on the specification on of the model. But for most standard models, you can do the Fisher separation setting here. Okay. Good. So then we go to the households portfolio choice. They have the same problem. The only thing is you have to be more careful. They should not be able to go short on the capital holdings. No, the portfolio share which goes into the capital holding is strictly or is weakly positive, can be zero, but cannot be negative. This is actually also the case for the experts, as I mentioned before, but it's never some of an issue because they always would like to hold more physical capital. Okay, so we have the same Hamiltonian as before. We have the co-state variable for them. We have the drift, the arithmetic drift of their net worth. We have the second co-state variable, which is, you know, the price of risk, this arithmetic version of it, times the volatility, the arithmetic volatility of that. And then we have this Lagrangian, this constraint, which is just this guy here, which I call lambda h. Okay. And the same thing applies, of course, also for the households. It's linear in theta, so it's a bang-bang solution, or you're at the constraints, and you have a Fisher separation theorem at work. Okay. Okay. So that's, then we can put this together. So we have the experts first order conditions, and we have the households first order conditions with respect to all the thetas. So we have the expected excess return of the capital holding beyond the risk-free rate is the price of risk of the experts times Q times K risk. So there's a K risk plus a Q risk. And then I have the Lagrange multiplier on the leverage constraint, and I have the Lagrange multiplier on the skin in the game constraint. Okay. Then there's also the first order condition with respect to outside equity. There's excess return on outside equity times the price of risk times the risk, exogenous risk plus endogenous price risk. And I have the Lagrange multiplier on the leverage constraint, and I have the Lagrange multiplier on the outside equity constraint. So this is just putting things together. And then I do the same thing for the households. The households only have this, that I can't go negative on the physical capital. That shows up here, this lambda H. And then I take the difference between the first equation and the third equation, and then I plug in what the return on equity on capital is. So, but that's the return on capital minus the return on capital for the experts minus the return of capital of the households. They only differ in the dividend yield. Remember, the experts, they are more productive. They have a higher A relative to the households. So that shows up here. In terms of the Q growth rate or the the expected capital gains, it's the same for both. The households get the same expected capital gains rate. They also have the same iota. Okay. So the only difference between the two is the dividend yield. So it's a difference in the dividend yield. That's where the difference in the expected return on capital is. The risk-free rate is the same, so you can, if you take the difference, and here take the difference, and then you get these expressions here. Yeah, and this is minus this guy, so it becomes a plus. Yes, so that's the difference between 1 and 3. And then I also take for the outside equity, the return on outside equity is the same for the experts than for the households. The experts go short, so they have to pay the return on outside equity. Households buy it, they receive the return on outside equity. So this is just 0. And then I get the difference here, and then I get the difference here. Okay. So that's the first order conditions which we will use later for the numerical implementation. Okay. Of course, I mean, there are all these Lagrange multipliers floating around. And we have to now divide the state space instead of when is what Lagrange multiplier binding, which constraints are binding. So we have this model of occasionally binding constraints. So we have to be very careful when is what constraint binding, and then these additional Lagrange multipliers are floating around. Okay. So for example, if let's suppose these two constraints are not binding, so the leverage constraint is not binding and the short sell constraint is not binding, then I could actually just plug in this lambda x here, and then I get you get essentially something here. Can they get so the lambda x goes in here, and then there's this goes in, so this becomes an alpha times this guy here with equality. If these other two guys are not binding, but if they bind, then so in general I could actually, so let's suppose lambda x is binding, so the outside equity constraint is binding. I just plug in this guy here. Okay. And then I can solve for that. You can think simplified. Okay. So that's what I have to do now. I have to now see when is what constraint binding. Oh, that's the next thing I would like to check, just to deal with all these Lagrange multipliers. Now, of course, we have now so it's a new setting. Now we never had this leverage constraint before. We had, this outside equity. We never had it so extreme that, we can issue some, but not much. So let's focus on this return gap between the outside equity return minus the return for households for the capital stock, and this return on expected return on capital for the experts minus the return on outside equity. If you take this, so I can also do this, so I can also this minus this and so forth. So I get these equations here. I get these Lagrange multipliers here. So now I have to look through, that requires a little bit of skill. that you have to look through, when is what constraint binding? No. So let's go. The household short cell constraint is not binding, and then let's say this household short cell constraint is binding. Okay. So if it's not binding, then lambda h is 0. That means, what does it mean? The household short cell constraint is not binding. The households are actually, they want to hold some of this asset, some of this physical capital. This is short cell constraint on the physical capital. So we know already from last time, when eta is sufficiently low, kappa, the capital share for the experts is smaller than 1. So hence for the households is larger than 0. So they have some of the capital. So they don't, if they want to go long, they don't want to go short. No? So if eta is sufficiently low, these households would like to hold some of this physical capital, so they don't want to go short. So this constraint is. Now, if eta is very, very high, it might be different. Okay, it might be that the risk of holding this capital is not the return. The expected return is very low. Remember, the expected return for the households is lower than for the experts because they don't get this high dividend yield. So they might say, I don't want to hold it, I want to go short. And then we're in this range. So this is for low eta values. This is for higher eta values. Now, then we have to ask ourselves, is it possible that the leverage constraint is binding, but the outside equity constraint is not binding? Okay. Now, you can figure out that this actually is not possible because the expert's capital holding return is always larger than the household's capital return. Why is that? Because the experts have a higher dividend yield. So in a sense, what the experts always could do is they could lever up a little bit more and issue outside equity, offload the risk. So they hold more physical capital and issue more outside equity. The risk is going to the households, but they get this extra return difference. Okay. So why would they not do that? Why would they only be constrained by leverage? So they are constrained by leverage. They can't issue more debt, and but they would always then like to issue more outside equity. So that's why this is not possible. Okay. So the other two cases are possible. So it's either everything is binding, so they can't issue more outside equity, and they can't issue more debt. So both constraints are binding. Or the other case where the outside equity is binding, but the debt or the leverage ratio is not binding. Okay. So these are the other two cases. Okay. So that's for the case where the short cell constraint for the household is not binding. These are lower eta values. When the households really want to buy some physical capital, so if you put yourself in the shoes of this problem, the households always prefer that the experts run the machine, the physical capital, because they're more productive. And then the experts issue some outside equity, and they could, in theory, pay a high return to the households. So why should the households ever hold a physical machine? They can hold just the outside equity claim. It's a little bit like you and me buying some shares on the stock market. We don't really know how to run these big companies. There's some good guys who have expertise in running these big companies, but we can help to risk share. And these guys, they are better in getting this, running these machines, okay, or this physical capital. Now, so that's always, so they would always do that. So how cell and short cell constraint is binding. So that's the case when essentially the experts are extremely well capitalized, and they are run essentially everything. They have everything well capitalized, and in this case, it is the case that the households, they don't really want to hold some physical capital because the return is short. So when if the return is low, and if the return is low, you would like to go short, but you can't really do that. Yeah. And it's in this model, so you can short some outside equity, but you cannot short physical capital. So when the return, the household, typically when your return is short and somebody else's return is high, sorry, not short, low, on something, you would like to go short to that, but you can't do this with physical capital. But there is, so what you do is you define the eta. Beyond a certain eta, then it is the case that the return for the households is lower on holding a machine than for the experts. And then it would like, these guys in theory would like to go short, but they can't do that. Okay, so there's a critical eta where this is the case. And in that case, it is impossible that the leverage constraint is also binding. So only the skin in the game constraint binds. So we will see that. So it's a little bit harder to see. So that's the drawback of this stochastic maximum principle approach, because everything is in the portfolio space. So we think about how do the portfolios look like of these different players. Later, we will actually do it more in the aggregate space, whereas the capital share and risk shares, it's easier to see. Okay, so now if you put everything together, we have this first order conditions I mentioned already. That comes from this thing here. We plug then this lambda x in here, and then we have all the different cases, and then we have these different cases, and then we have one case where this holds. So they expect the expected excess return of the experts' dividend yield beyond the household's dividend yield. It has to be larger than the difference in the risk premium. Remember, there's the price of risk times the risk. That's the price of risk of households times the risk. So the difference in this times alpha. Where does the alpha come from? It comes from the fact that if you plug in this lambda x here, so you plug this guy here, there's 1 minus alpha, then there's this guy, and this 1 cancels out, so the alpha remains. It can bring it in front of this guy. Okay. Now I could have written this with equality. So this with equality, if I put all the Lagrange multipliers still there, but with inequality, with equality, if I express this now not in terms of the lambdas, not in terms of the thetas, but also in terms of capital shares and risk shares chi. Okay, and for this I have to translate these things into the skin in the game constraint into the chi's. That's what I do here. Okay, so that's, if you think about, that's the risk for now it's aggregated up. The risk of the equity held by, that's the total net worth of the experts. Oh, there should be no superscript k should be over in the theta. Okay. This should be theta e k, and this should be the eta e. Plus the offloading sum. This is a negative number, but how much they can offload is given by this thing here. And if you put it together, then you have this chi e, which is the risk held by the experts, has to be larger than alpha kappa e. So, but this makes a lot of intuitive sense that the risk share they have holding has to be alpha times the capital share. So if they hold, let's say 80% of the machines, and alpha is a half, they have to hold at least 40% of the aggregate risk. Okay. And here's the leverage constraint. So again, we have here the leverage constraint. They say, okay, how much debt can you issue? It has to be smaller than this expression here. So that's showing up here. And if you just realize this, you have to do a little bit of algebra to do that, to plug this in. And I've used already here this constraint to plug this, express everything in kappas and chi's rather than in thetas. Okay. And this is then what we use, what we run with in the numerical thing. So putting it together in a nice box. So there are different cases. So the easiest way to see it is to have over eta. So for very low etas, it is the case that the experts are leverage constrained. So the leverage constraint holds. So that means lambda L is strictly positive. So the leverage constraint holds. But also the expert skin in the game constraint holds. So that's skin in the game constraint also holds. And but the short sale constraint does not hold, because the households hold some physical capital. They don't want to go short. They are long physical capital. So the experts, that's, if I were to write this kappa H, would be strictly positive, it's larger than 0. So kappa E is strictly smaller than 1. Okay. That's correct. So the households, they're less productive in holding it, so they get the lower dividend yield, but they of course think the ether is growing again. With it, the capital value is growing, so Q is growing it. So they buy the machine hoping that the mean appreciates in machine, or the physical capital appreciates in value, then I can sell it back to the expert later on. And that's part of their calculations. They're speculators essentially in this framework. So then this delta risk premium, that's this was this expression here. That's strictly positive. So there's the expected difference here in the dividend yield is strictly larger than this delta risk premium. So that's here. It's binding in this region. So when eta is very low, then this delta risk premium condition is tight. And because of this risk sharing, because there's no perfect risk sharing. So perfect risk sharing is only for very high eta values. Okay, perfect risk sharing means if you have a higher net worth share, you also have a higher risk share, no? And it's proportional because both are equally risk averse. Now, there's no difference in risk aversion between experts and households. There should actually, the optimal risk sharing would mean where wealth share is equal to the risk share. If you're more wealthy, if you're more guys, but what matters here is the risk-bearing capacity. If you have more risk-bearing capacity in terms of wealth share, you should also have a higher risk share. But typically, the experts, they have a higher risk share than their wealth share because they are more productive in managing these machines, and they're typically undercapitalized, so they don't have enough wealth. The wealth share is not high enough, only in this high eta realm. So let's go through this again. So these are the different regions, different cases. In the case 0A, I don't know why the numbering is this way, but that happened this way. So just the reasons there. In this case, it is the case that the experts are leverage constrained. They would like to issue more debt, but they can't issue more debt. Okay. It is also the case that the experts would like to issue some more outside equity, but they can't issue more outside equity. So in this, when the experts are really badly capitalized for very low eta values, they would like to issue more debt and they would like to issue more outside equity. Both constraints are binding. Okay. The constraint which is not binding is actually the household short sale constraint. So the prices are so depressed that actually the expected returns going forward, the hope is that the price appreciates, and so the households are even willing to hold some. They're long this physical capital. Okay, they get lower dividend yield, but they're hoping the capital appreciation is making up for that. So that's the case here. So that's the first region. In the region 1A, then it's the case the leverage constraint, it's the same. The leverage constraint is not binding anymore. And sometimes this case, depending how this L parameter is chosen, this case 0A might stretch over to, all the way to this 1A region. But this 1A region, no leverage constraint. Leverage constraint is as if there was no leverage constraint. It's not binding. But the outside equity constraint is still binding. They would still like to issue more outside equity. You always would like to buy more machines. And if you can issue outside equity, you just issue some outside equity. Only if you're really well capitalized, you don't need to do it anymore. And so in this region, it is the case actually that the households hold some physical capital. We call this the fire sale region or the crisis region because the households, the unproductive households hold these machines, which is a total misallocation in a sense from a productivity perspective. Okay. Now in this case now in 1A, it's the experts still would like to issue more outside equity. They would like to share more risk, but they can't do it because of the skin in the game constraint. But 100% of the physical capital is held with the experts. So there's no misallocation in terms of physical capital. And then in this one, in case 2A, then there's no constraint binding, except for the household short sale constraint, but there's also perfect risk sharing between the two groups. Okay, these are the four categories. And then when we do solve the whole model numerically, we start here and then we solve it and iterate and then solve it up, we solve it over and then switch whenever one constraint switches on and the other one switches off. we have to then modify our code. Okay. Okay. Because Hunter really wanted the martingale approach, so we have to do the martingale approach. So the martingale approach is typically always we just look at this formula that expected return of a self-financing trading strategy is just the risk-free rate plus the price of risk times the risk of this trading strategy. So we can do that. And we just have to be careful now. What is the risk, the price of risk? Okay. And the price of risk is actually depends who is holding what at what rate. And so one way for the martingale approach, you have to look through things and have a good economic intuition to get things. So the stochastic maximum principle approach is more mechanical. It's like, oh, step 1, step 2, step 3, all the lambdas, plug in the lambdas, and you do algebra. It's more mechanical and it's probably safer in many regards. If you see already through it, you just use the martingale approach, which, you know, the martingale approach is derived essentially from the stochastic maximum principle approach. What's new compared to lecture 4 is this thing you have to take into account that part of the risk is held by the experts. So their price of risk matters, and part of the risk is held by the households. Okay. So the experts, they're holding, you know, they're holding some risk relative per capital unit. This is a excess risk share, and this is the risk share held by the households. Okay. So that's how much capital risk is there. But the risk share is higher than the capital risk if chi is larger than kappa. Okay. Hunter? That's on equity, yes. So the outside equity is essentially already plugged in, no? So that's already, that's the risk on equity, but it also reflects already that some of this risk offloaded. So this chi is the risk after offloading. Yeah. Same risk, yes. So the expected return on equity or on same on capital. And capital, yes, it's the same risk. So the loading on the Brownian is always sigma plus sigma q. So it's the same risk, but the expected return is different. No, only in so price of risk is only equalized in this region. So in all of this, so that's there's my. So you see, let's suppose if these two constraints are not binding, you see that, then this price of risk of experts is equal to price of risk of households. So typically, the experts, they're levered up, they hold more risk. Because they're more risk, so the net worth becomes more volatile, so their price of risk is higher. So the expected risk is higher. So this thing is higher than this thing. Okay. But on the other side of the equation, the price of risk is higher than the price of risk of the households. And the reason is that the experts, they're levered up. So their net worth is much more volatile. Remember, the price of risk with log is just the volatility of the net worth. And so their net worth is much more volatile. They're levered up. And hence the price of risk is higher. And that, of course, is translated into this higher. It has to be coincide with the higher excess return, expected return on capital. They have different returns. So the experts have a higher return, but that's why they're loading up on the risk so that they also require a higher price of risk. So that's what's going on. Okay. So then the households problem is still is given by this expression here, the household's capital choice. And then you just have the capital market clearing condition, you just plug it in as we did. So the thetas, so essentially the thetas have to add up to capital market clearing condition. So that's would be the martingale approach. So we can use the martingale approach as well. It's very much if you plug in correctly the other settings, you can stochastic maximum principle approach. solve for the Lagrange multipliers and all this, you can get a similar thing here. I should say here, I just did it for the skin in the game constraint. So you can issue outside equity, but there's no leverage constraint. So I haven't done it for the leverage constraint, the general case. Okay? Because once you have several constraints interacting, you have to be more careful. And then it gets a little bit more tricky. Now, but the next approach, so we did the portfolio approach optimization. You can do HJP approach if you want. You can do stochastic maximum principle approach, or you can do the marginal approach. Or you can just say, I go immediately to the aggregate level and do a social planner approach. Okay, a social planner, which is not a welfare social planner, it's a price-taking social planner. Okay, it's different from the second welfare theorem. Okay, it's just a price-taking social planner. And let me illustrate why this works as well. So when we did the stochastic maximum thing, with each guy is maximizing this thing. So I probably should not make curly brackets. So the households were maximizing this thing with respect to theta. It was a linear objective. I divide things. I think there is something missed. Oh no, sorry. So this I divide by CH and N times NH. So I have essentially maximized this minus this. There's only the price of risk showing up here. And with Lagrange multiplier, I can divide this and I can solve for these thetas. Okay. And I do the same thing for the experts. That's the same problem. And so I can say, I can, instead of maximizing individually, so that's the experts maximization problem is here, and the households maximization problem is here. I just have a planner who maximizes all of that. The oldest theta E is floating around here, and the oldest theta H floating around here, and it maximizes over theta E and theta H. It's the same thing. I can maximize a convex combination of the two things. Because the terms are only showing up here or they're showing up there. Okay. So I can choose either weights to sum the experts in the households maximization problem. I can choose any weights. Okay. And this gives me then this becomes then in here there's the expected returns of the experts. In here the expected returns of the households. If it minus let me go back again. So it's the expected returns of the experts minus, let me ignore the constraints for now, minus the price of risk times the risk of the experts. And for the households, it's the same, the expected returns of the experts, of the households, minus the price of risk times the risk of the households. And I can, so one is in this term and the other one is in this term. I can just put it together, make a convex combination of that. Same thing if I maximize with all theta E's and with respect to all theta H. But now why do I pick the eta E and the eta H? If I pick, I can pick any weight, but if I pick these weights, then this portfolio thing becomes the capital share. So eta E times the portfolio weight of the experts in capital, that becomes the capital share of the experts. Okay. And the portfolio weight of the households in capital times their net worth share becomes the capital share of the households. Okay. And all the zero net supply assets, they're cancel out. Well, we did this already last time. The debt where I said, oh, theta E times the portfolio weight of the experts plus theta H times the portfolio weight of the households, and that is because one is long and the other guy is short. So these guys are long, the households are long, the experts are short, so that's zero. So all of the assets, so that's everything which is gray, we did already last time. All of this stuff which is zero net supply, which is debt in outside equity, they cancel out totally. Okay, so they don't show up anymore. So if I pick the weights, eta E and eta H, or eta and the other one, 1 minus eta, then these guys cancel out, and what remains is only the capital return. Here with the capital share of the experts and the capital share of the households. And then I have the risk terms, because I have these risk terms also in my HJB, in my Hamiltonians. This was this risk terms, that's for the households, and this is the risk term for the experts. These terms are showing up here too. And so all of these things shows up here only. And this becomes then the risk weight of the experts, which is, you know, what they put in the risky capital times the eta wealth, the eta wealth share. And this is the risk weight of the households. Yeah. I think I forgot some of this. There should be, I have to put the outside equity stuff in here too. Okay. So that's essentially, that's what I do. And if I do this, I just maximize, and this whole thing translates then, I'm maximizing the expected return of total net worth in the economy minus the price of risk times the risk weight of the experts plus the price of risk of the households times the risk weight of the households, the total return, the volatility of the total capital in the economy, or Q times K. Okay, so I have the expected return of all the risk in the of all the capital in the economy, which kappa E is held by the X, they produce AE, and kappa H is by the household's productivity minus iota. That's, remember, this was the dividend yield. And then I have the capital gains for the experts and for the households, but they're the same. So it's just kappa, and the other one is 1 minus kappa. So it adds up to 100%. So that's expected capital gains, expected return of the total net worth in the economy, minus the average price of risk of the economy. And, you know, a risk share of KI is held by the experts, so the price of risk of them matters, and the risk share of KH is held by the households, so their price of risk matters. And then I have to, you know, the constraints we did already before. There's the skin in the game constraint, same equation as before, and the leverage constraint. So rather than having all the thetas floating around, I also have to translate them again from this lambda or theta constraint in the kappa chi constraint. So I plug it in here, and this is my constraints. Just, you know, plug it in directly. So what you get then is, again, you have a linear specification in the objective. So this is kappa, and this would be 1 minus kappa, because they have to add up to 1. This would be chi, this is 1 minus chi. Okay. And where's the price? Why is it called a price taking social planners problem? Where's the price? Yes, so they take the price of risk as given, no? That the var sigmas are price of risk, and the Q is also a price. So, because if I solve this problem, each guy takes the prices given, and I move to this price-taking social planner, he also takes the prices given, but he maximizes then the capital share, how much of the capital is managed by the experts, and how much the risk is held by the experts. And because I can issue outside equity, I break these two things apart. Before, in the last lecture, I couldn't issue outside equity, so the price, the amount of capital share was also the risk share. If you hold 100% of the machines, you have to hold 100% of the risk. Now you can say I hold 100% of the machines on the physical capital, but I only hold 80% of the risk, and 20% I sell off. Okay, or whatever. And once I do that, I get this first order condition directly from this. That's the other approach. I just maximize this with respect to kappa, plug everything in. Then, you know, kappa here is 1 minus kappa, so this becomes a minus AH. The Q shows up. This doesn't show up. This becomes chi, and this is 1 minus chi. So then there's a difference in the risk premium. And then there's this here is sigma plus sigma Q now. Okay. So this slide is the same as the other slide. You do the same thing. It's exactly the same thing. Okay. So here's a more general, so the price taking social planner, if you want to do it more generally. And essentially, if you do the thetas, you have to do it. So let me, and as I mentioned this last time, if I have one Brownian motion and I have 15 different assets, like I have the risk-free asset, I have the outside equity, I have the physical capital, I might have another asset on it. I have to deal with all these 15 different assets with further dollar conditions. But if I do capital and risk shares, oh, I only have capital and risk shares. Okay, but because there's one capital, there's capital allocation, and there's risk allocation. If there's only one Brownian, there's only one risk allocation. So if I have that specification, a lot of assets and few Brownians, then it's better to work in this kappa chi space. Okay. If I have a lot of Brownians, so in a more bigger model, so I have 15 Brownian motions floating around, but I have only 3 assets, the markets are highly incomplete. And then I probably want to do more in the theta space because I have few dimensions in theta space and then deal with that. Okay. So it depends a little bit what setting you have, which approach is the more easier. But in general, you can always do the stochastic maximum principle approach and just go mechanically through it. Okay. The other things are just shortcuts. And the price taking social planner, this is the most general specification. What you maximize this kappa can now be the capital share can be a multidimensional thing, and the risk share, depending how many Brownians you have, can also be a multidimensional thing. But you always maximize just expected return of total net worth in the whole economy minus the price of risk times the risk. Of course, this chi, it can be a huge vector, and the sigma chi can be a matrix in this. And in equilibrium, this has to be equal to the risk-free rate, but that's what you maximize over the chi and the kappas, subject to a constraint. And the financial constraints could be, you cannot issue any outside equity, then kappa has to be equal to chi, for example. Or you can issue some alpha fraction of it. So kappa, so chi has to be smaller than 50% of kappa, alpha times kappa. Okay, so that's just the thing. If you find this cumbersome, you don't need to know this price taking social planner thing. You can just always do the stochastic maximum principle. So we always live within, for the consumption choice, we still have to do the stochastic maximum principle anyway, or the HJB approach and things like that. Within the finance block, you can use the martingale approach, you can use the stochastic maximum principle approach, or you can use the price taking social planner approach. Or HJB approach too, whatever you prefer. Okay, so that's the finance block. You've done it. Again. So what we'll see in this course is that, so this toolbox we put together, you can use it, we will enrich it, of course, little by little, but the baseline, the basics are always the same. It's just, that's what the plan is. Now, the evolution of the state space, the eta, so what drives eta evolution? Remember, so we had the net worth evolution of the experts, then we had eta was just net worth of experts divided by Q times K. So we had to take the eta ratio rule, but we could also take a change of numerea. Now, the net worth in consumption numerea is something, but if I make it net worth in the total net worth numerea, then net worth is eta, okay? And then I can use the martingale approach to just get the eta out of it. But you can do both ways. It's whatever tool you like more. One is more algebra, the other one is more getting through it very quickly. But the lecture now is the same. It's just we have more in the finance block, but the eta evolution is the same. So what's the drift of eta? So it depends how patient the experts are relative to the households. If the experts are less patient, they consume at a higher rate. So the drift is going down, is less positive or is negative. But if the experts are more productive and get the higher risk premium, so typically it's a consumption difference. And the experts, they hold on more risk, they get risk premium for that. And so this risk premium is a positive element that pushes eta up, and consuming more pushes eta down. Okay, so that's the same. And the state variable is eta. We solve the whole system, and once we have solved the system, iota pops out too, and then iota drives in the total aggregate capital stock. And then for the value function, we don't have it so far because we have log utility. Log utility, price of risk, is just the volatility of the net worth for each of the two agents, the experts and the households. And yeah, that's all we need. And the consumption choice is just rho times the net worth. We derived this in the initial lecture too. So that's it. So we can go to the numerical solutions. So here is just our big picture again. What's different now? That is the capital allocation, the physical capital allocation is kappa, and we have the allocation of risk. So we have some constraints floating around here, okay, on the financial side. Here's the physical side. You can call this the macro side. Here's the finance side, so it's microfinance. Okay. Okay, so let's do the numerical solution. So we have to put all our building blocks together, and then I show you how to solve these things. So we obtain the kappa, the capital share, from the goods market clearing condition, which is based on a difference in the risk premium. That was our difference, so difference in price of risk. Which guy has higher price of risk again? Experts, because they're levered up, so their volatility of the net worth is more volatile, so they have higher price of risk. But they're happy to hold it because they get also higher risk premium. So that's the risk and times the price of risk. So it's a difference in the risk premium is this whole thing. So for log utility, actually, so the price of risk, as you said, is just the volatility of the expert's net worth. And this is the price of risk for households, the volatility of the net worth of the households. And we have done this earlier. And that's just this expression here. Everything which is in gray is the same as last time. Okay? So that's, we can just, plug this in here. So essentially this guy is, the difference in net worth is also the difference in etas. But different in net worth volatilities is different, is the same as the different in eta volatilities. And then we can plug this guy's in here and this guy's here, and then we get this expression. So we have seen this. So once I put this everything in, once I replace the var sigmas with this, I get this expression here. Okay, and that's the same. We had this inequality with equality if this is like this, and if now this leverage constraint is showing up here as well. Okay, so what's new now is that we have this alpha floating around. That's because you can offload some of the risk to the households. And we still have this, this is the short sale constraint of the households, and we also have the leverage constraint. So now what's a chi-e? So the chi is the risk share of the experts. They hold alpha of the capital they're holding. Okay, 1 minus alpha they sell off. Or they hold the whole risk if eta is very high. So they will never. So if they have perfect risk sharing, then as I said earlier, in this region 2, the last region, chi will be equals to eta. Okay, so the wealth share, the risk bearing capacity share is equal to the risk share they're holding. If they are not so well capitalized, then then there's no perfect risk sharing. So then it's a smaller number. It's this number. And then we also, when you plug everything together, determine. So you have to go through this math, a little bit of algebra at home. Is the leverage constraint region? The leverage constraint region, we can also determine the kappa. So we want to determine the kappas here. So we have the kappas showing up here. We have the kappa here. We have the kappa here, and also the kappas showing up in these constraints. Then we have this Tobin's Q. I didn't mention it today, but this is always the same we had all the time. Okay. Then we had from the amplification slide. So this is a slide we did last time, but there's nothing different now from compared to last time. This was one of my favorite equation, not the favorite equation, one of my favorite equation. What was it again? that shows you the amplification. Where can you see the spiral in this equation? We did this last time. Exactly, there's a spiral. There's a first round effect, second round effect, third round effect. So it's a geometric series, the sum of a geometric series. So it's the first element divided by 1 minus. And so this depends, that's like the risk share minus the equity share. So if there's perfect risk sharing, this is 0 now. So if the experts are fully very well capitalized, then this will not be amplified. But if they hold more risks than their well share, then this is actually some excessive, or not excessive, there's some additional risk taking by the experts. That causes the whole thing. And then it depends, this is the elasticity of Q with respect to eta. How does Q react as eta changes? And of course, you can rewrite it this way. That turns out to be numerically easier to do. Okay. That's the elasticity of Q as eta moves around. How much does Q move around? It's primarily driven by the slope of the Q. Okay. So we have this, and we have the Gutzmacher gearing condition. It's the same as last time. There's no difference. So it's only the financial frictions where the difference are showing up, but here there's nothing different. And then we have the algorithm. And that's the same algorithm as before. So we have 5 static conditions. Last time we had 4 static conditions. Okay. What's the difference? So first, the Tobit's Q is the same. The social planner's condition with respect to kappa E and with this chi E is a little bit more general. So there's this alpha floating around. We didn't have this alpha last time. Remember that? So because now you have to hold our fraction alpha. Last time we had to hold 100%. So alpha was 1. Okay, now alpha is more general. And also here, the planar condition is that we have this maximum between this guy and this guy. So you can think of alpha equals 1 was the previous case. And then we have the Gutzmacher gearing condition, that's the same as before. And we have the amplification condition, which is the same as before. And so what we do is, like last time, nothing is different. You start at eta equals 0. So the experts have no well share at all. They have 0 well share. We can solve this, and then you start solve to the right. So you start it, and then you solve to the right, and then you go walk up along the eta space. So you start at eta equals 0, or I have to do it the right direction and from you to see it. So you start at eta equals 0, and then you know what Q0 is from the fact that there's no experts around. It's only the productivity of the households. They're just managing it all the time. And there's no eta. Eta is just fixed at eta equals 0. And then you just say, look, one grid point up, another grid point up, another grid point up. So you solve this ODE as you go walk through the grid points. And now it becomes handy to go to these regions. Now you say, okay, in this setting, if you're here, we have the expert's leverage constraint is binding. You can just plug the leverage constraint in, and then you get already your kappa out of that. Okay. And at some point, you will notice if you solve it the normal way, is this still binding? You solve it, it's not binding anymore. So on the skin in the game constraint is binding. And then you walk further and further, you make a regime change, and then you solve it further as you go. And then the kappa E becomes binding. And then so forth, you walk your way through it and you build up your Q function. Okay, so let me do this again. So as long as the kappa E is smaller than 1, so you solve the ODE for a given Q in, you plug in the optimal investment rate, this guy here, the Tobin's Q, into 4. So this is plugged in here. And then you plug in the planner's condition chi, so that's number 3. So you plug this in here for chi. And then the solve the ODEs using the 3 equilibrium conditions, 2, 4, and 5 via the Newton method. Remember the Newton method from last time? You solve for the roots, and you have this, 3 things to solve for, and you just want to have the root, which is these 3 things. Everything is written that everything is equal to 0. So this was my Gutzmacher gearing condition. That's my amplification equation. That's the planner's condition. Now what's new is there's this alpha floating around. Okay. And I have to plug in these kappas, these iotas, and this chi, depending which region I'm in. There's one constraint or the other constraint. I have to plug it in. And I solve. So there's this is just a one-dimensional representation here. I'm here, I take the derivative and go down, so this is my solution. And then I go up again, take the derivative and say, oh, take the tangent, oh, this is my solution. And then this way I iterate it and quickly get them the root, which everything is equal to 0. So I do this, and then I check, is actually leverage constraint binding or not? If it's binding, so that's a new thing. If the leverage constraint is binding, then I replace the kappa E with the leverage constraint. And then I solve 3, 4, and 5 this way. Okay. So I do that, and I say, oh, it's a constraint binding. And then I go up another eta, is the constraint. Oh, it's still binding. And at some point I will realize, oh, it's not binding anymore. And then I can just, I can check this all the time and just check whether it's binding or not. And then at some point I hit the point where kappa, let me go to this thing where the kappa is 1. So I hit, this is a fire cell region. So that's the kappa E is smaller than 1, strictly smaller than 1. So the household holds some physical capital. Then I hit this constraint, and then I go over to a different regime. Now, when I'm there, then 2 is not more informative. So then I solve 1, 4. So I use 1 and 4 to solve for the Q. So when the constraints binds, we directly substitute in this kappa E from the constraint. So, so that's what's going on here. But that's the same thing we did last time. Now, let me show you the outcome. And you have to play around. So the only way to learn this is to really do it. You can't just, I mean, it looks nice, but you have to play around with that. So this is actually fairly new. We just did this recently. There's a leverage constraint of 55.55. So that means leverage of constraint of 1 is no leverage constraint. Okay, so it's like a collateral constraint in a sense. So you can only borrow 55% of your collateral value. And so what you see, let me just show the capital and the volatility of the capital price. You see the volatility is very high. So there are 4 regions. So there's first a region where the leverage constraint and the outside equity constraint is binding. And so this is a region of fire cells. Okay, so fire cells start here like we had all the time. So this is a fire cell region. But if you go get the situation get even worse, at some point the leverage constraint starts binding on top of it. Okay, so there's actually a little kink here. Okay, and then there's a region here where there's there's 100% of the physical capital is held by the experts, and households don't hold on physical capital. They're short cell constrained. And then there's another region here where there's perfect risk sharing. Okay. The chi is equal to kappa. So let me go. If you look now at the drift and volatility in arithmetic terms of eta, the state variable. So there's negative drift here. So the system drifts here to the steady state. And there's positive drift here, the system drifts back to the steady state. Okay, and the volatility is not so high here when the leverage constraint binds, but it's very high in this region because when the leverage constraint is not binding, but the fire cells are going on. Okay, so that's when the volatility is highest, and this has important implications. We will see in a minute what this has. Now, so if I look at the risk allocation and the leverage, so the risk allocation is that how much risk is held by the experts. So you can see that, here the risk of the experts is like this. So it goes to 80%. And then if they have 100% wealth, they hold even more the risk. So if, of course, if there's 90% of the wealth, they also hold 90% of the risk because they do perfect risk sharing. So this is the perfect risk sharing area here. But here they hold already 100% of the physical capital, but they only hold 80% of the risk. Why is that? Because alpha is 80%. So alpha means they have to hold 80% and 20% they can offload. Okay. Last time we had alpha equals 100%. You can't offload anything. And so that's essentially the risk sharing. And how does this differ from the last time? This is a cap, that's a leverage ratio. You see, as they become less and less wealthy, the experts, they lever up more and more. So they still want to hold all the machines, all the physical capital. They will sell off the outside equity. And then they also would like to hold and operate these machines because they're much more productive in operating these machines. But at some point, the leverage constraint kicks in and they can't hold this. So in the last time, this would have gone up here. Okay. So this leverage goes up and up and up. Here it's capped now because of the leverage constraint. What is the 4? Or 4? Or the deep meaning of 4? Why is it exactly 4? I don't have a good answer now. It is related to L, but I don't know whether it's 1 over 1 minus L and this is 4. No, probably not. Second? But it is a transformation of the L thing. So there are 2 points. One is most traditional macro, like a Kiyotaki, Moore, BGG, they only have a leverage constraint. I mean, they have no outside equity at all, and they only do leverage constraint. So you want to have in this framework, you also want to do some leverage constraint in a sense. That's the most macrofinance models do leverage constraints. Okay. Now I will show you some really cool stuff in a few minutes. What this leverage constraint will do. But you know, you will see, you have to wait. Okay, so here's just a comparison. So the risk allocation. So if I have only outside equity, so that's what we had last time. This was alpha was equal to 1 is the black line, the black dashed line. And no leverage constraint means leverage is 100%. So you can, collateral is, you can borrow up to 100% of collateral. So this is outside equity. So essentially there's better, the risk, you can offload some of this risk. You couldn't offload earlier. Okay. And the leverage constraint, if you have a leverage limit, you see there's some difference here. Of course, it shows up already a little bit earlier because people anticipate the leverage constraint might be binding down the road. Okay, so it might be that the zeta drops down. So it's, even though it has already implications before it binds. Okay. Now I have to double check that. Of course, with log, it might be slightly different. It binds only here. So when you really, yeah, in the very left. Here, that's what severe region, the leverage constraint and the skin in the game constraint binds. And the skin in the game constraint binds all the way here. And the fire cell region starts here. So the fire cell happens, that's already crisis. And then you go deeper in a crisis, that's when the leverage constraint binds on top of it. So here you can see it more clearly. So this is like the leverage itself. This was the picture where saying I just introduce outside equity. By introducing outside equity, they can hold actually a larger fraction of the capital share relative to the wealth share. So allowing outside equity, they can actually say, oh, we hold more machines. So that's the red one instead of the dashed one. But if I put a leverage constraint, this is like the blue one, they can only level up to this level. Thanks. Yeah. But the fact here can issue outside equity, the blue one can issue outside equity and leverage constraint. So issuing outside equity relaxes the constraint a little bit because I go from alpha to 0.8. So you only have to hold 80% of the risk, but the leverage constraint tightens it again. Okay, but these are different constraints. Now, if I say, what does it do for the for the price volatility, so that's a sigma Q, you can say if you have only outside equity, so what it makes, of course, you see the first thing you see outside equity makes actually crisis region smaller, okay, because it can offload 20% of my risk. So that's one thing, but it makes actually then, it makes when the crisis comes, the volatility is higher. Okay. So I offloaded my things, but when the crisis comes, then I really have less space and I have to offload it faster. Now, if I have a leverage constraint on top of it, so if when I have this outside equity, the red one, and also a leverage constraint on top of it, what's interesting is that in this interim region, when the leverage constraint does not bind, so this is here, the leverage constraint binds here, then it doesn't bind, but there's fire sales going on, the volatility is even higher. Okay. So I try to, stay away from the leverage constraints, or yeah. Can't tell you really why this came, but yeah, but that's what comes out of it. So here's the volatility paradox. Here, that's essentially, I think what I find very fascinating is that if I now vary as a very fundamental volatility sigma, so the underlying sigma, I go from 10% to 8% to 6%. And if we look at the volatility of the net worth share, the peak roughly stays the same. It shifts a little bit the region is shifted because the fire sale part comes later if there's less volatility. So the blue one is the one with the least fundamental volatility. So the fire sale region comes later, but the total volatility is roughly the same. As fire sale, when the fire sales start, you get the same volatility out of that. Okay, so what this means is that if you lower the fundamental volatility, the endogenous volatility is going up. And you see this a little bit. So you see the endogenous volatility is actually going up. Sigma Qs are going up. So the fundamental volatility K is less volatile, but the price volatility goes up. So the Q volatility, sigma Q, is going up. You're compensated from this, you get a high risk premium, so you drift out of it more quickly. Okay. Now, this was the case when I have only outside equity. Now, if I put now a leverage constraint on it, then something very interesting happens. So you see that now the Q is really going up. It was going up before. And then there's the volatility is coming down more quickly. So when the leverage constraint is binding, so if I move to lower volatility, the leverage constraint becomes binding early on, and actually it depresses the volatility. So the leverage constraint makes the volatility go down. Okay, so remember, if you look back to this one, this has this belly here. Do you see this belly? And here it's after starvation belly. So that's essentially, so I have, but you will see in a minute, this has huge implications. Okay. So the leverage constraints brings actually volatility down. It also for the drift, the belly becomes a starvation belly. And this is, it moves a lot. You see how this is, the drift is always high. And here the drift is really collapsing. So if the volatility goes down, I have the leverage constraint, the drift is not going. Why is this the case? Do you have an intuition for that? So the intuition is the following. I have all these great opportunities out there. I could load on it, and there's this potentially high expected return on holding these machines. I would love to lever up, but I can't. That's why my risk premium, there's this huge risk premium out there, but I would like to hold more machines to take advantage of this risk premium, but I can't because of my leverage constraint. So that's why my drift is not so high anymore. So here the drift is fantastically high, and that means in the long run I grow out of the recession, out of this thing very quickly. But if I have this risk leverage constraint, I don't get this risk premium anymore. Of course, the volatility is also lower because I cannot take on the risk. But I would love to take on this risk. I would love to lever up, but the constraint doesn't allow me to lever up. Okay, might be a regulatory constraint, might be collateral constraint, whatever. It doesn't. I would love to take advantage of this high expected return. I can't. Of course, I have less risk, but this means, you know, the drift is also much lower here. Oops. Now, what I want to do next, so I need another 5 minutes, perhaps 10. So I want to do the stationary distribution again. We did the Kolmogorov forward equation, remember? We said, okay, how does a distribution change over time as time changes? So of course, it depends how eta changes, and the eta changes, the drift of eta is what it changes over time. And that's one term. And the other term was this type of eta term, where it's half the second derivative. Okay, but then the volatility shows up here. Okay, so we did this last time. Now, but if I want to do the Kolmogorov forward equation, or in physics referred to as the Fokker-Planck equation, if I want to see what's the long run stationary distribution, it is not changing over time anymore. Then the change over time is 0. And so everything simplifies to this equation. So in particular, I have this, the changes is always so you can solve that in this expression here. So I will leave it up to Garton to show. But the only thing I would like to highlight is when you solve this, to define what function of eta solves this whole thing depends on this integral, but it always depends on this mu divided by sigma squared. Okay, so this is a drift, and it's and the volatility divided by volatility squared. Okay, and this eta shows here up in the upper end of the integral, and it shows up outside. Of course, this has to be integrating over the whole. There's a constant that the whole thing integrates over to 1. Okay. Now, once you put this in, you get the stationary distribution. Now with this leverage constraint, and this you get this distribution. Yeah, that's when you let the system run for millions of years. How often will it? What eta will be there? And then you spend a lot of time here. But I want to play around a little bit with that. And here's the most interesting graph of the lecture today. It's a net worth trap. What's a net worth trap? It's the stationary distribution is double hump shaped. Do you see it? Do you see that the system, let's look at the red one. And what's really striking is that, so when the sigma is 7%, then the system lives a lot of time here, but it also lives a lot of time here. Okay. Without leverage constraint, you don't get this thing here. It's because of the leverage constraint. So if you have a regulation which imposes leverage constraint, you make sure that the banks will be undercapitalized for a long time. Hunter? So yes, so we will do this in a minute. You will only be here. So once the volatility goes down even further, it becomes the Dirac mass, and there's no stationary distribution anymore. So the system will actually go towards eta 1 or eta 0 and stays there. Okay, so you spend all of, I mean, initially there's a transition phase, but then after a while you stay there. Remember, we always had the problem that eta was going to 1, but here then it goes to 0. Okay. Of course, what we have assumed is that the experts consume at a higher rate than the households. That's going on in the background too. But what's interesting is that if the volatility is 10%, you don't have this. I mean, you have a little second hump here, but if you have 7%, then there's this big hump showing up. And if you have 4%, this whole thing collapses. Your station distribution is mostly here. Okay. So when the volatility, fundamental volatility, it's another form of volatility paradox, even more drastic. If you make the fundamental volatility go down, the banks are mostly undercapitalized. Okay. And the lower the fundamental volatility is, the less undercapitalized they are. It's like a Minsky instability theorem. Okay. Do you see that? Man, I thought you would be more excited about this figure. This is the figure of the day. So so Hunter was asking, what's going on in the blue one? The station distribution might not exist because it just collapses to, once you make the transition to zero, you just stay at zero. And we have to understand, where is when does a station distribution exist? Some ergodic distribution, and when does the station distribution becomes a Dirac measure? It just fixes on one point. Okay. Yes, so I will come back to that. That's slightly different, but I think it's related to that. So let's first see when the station distribution exists. So if you look at this, so what matters is really this 2 mu over sigma square. So this can give you some hunch how you can, how this drives it. And this is in our case, it's a drift of the geometric drift of the eta and the sigma, the volatility squared of the eta. Okay. Okay. So let me jump over that. So let me give you, just to give you some intuition, let me make a side comment. Okay, that's just switch to a more stylized station distribution, unrelated to our model. And not totally unrelated, but more stylized to see something. So let's suppose there's a geometric Brownian motion. So this mu is not time varying and the sigma is not time varying. Okay. And there is an upper bound of reflecting barrier. When you hit D, it reflects back. Okay. So you hit D and it can't go beyond D, and then there's another shock and comes back. Then I can, for this one, you can find an explicit solution. Yeah, that's the advantage of this particular. Our model is too complicated. You can only find a numerical solution. So the KFE, the Kolmogorov forward equation is this expression here. And we have this station distribution already. And then you can actually, if you plug it in Mathematica or whatever, find the explicit solution here. But all what I want to show is that, it matters this 2 mu and the sigma square matter a lot. That drives the whole thing. And it matters whether this whole thing is smaller or larger than 1 or smaller and larger than 2. Okay. So once you solve this, you look at the stylus thing, you see, this is actually for a very, a Brownian motion, geometric Brownian motion with a reflecting barrier. You can think, perhaps we have something related to it, but more general than that. But at the boundary, at the corner, at extreme levels, it is close to this one. Okay. So the question is, when is this fx a density? Because of this reflecting boundary, and there's some pullback effects by strong enough. So if the drift is strong enough, then there's some pullback effects. So let me just go to our setting. So we have this 10% fundamental volatility, 7% fundamental volatility is the red one, and we have the blue one, which is 4% fundamental volatility. And the blue one might not exist. And if we go for eta close to 0, then using now this expression here, so eta close to 0, so then you can see that if this expression is larger than 2, so we have this guy here is larger than 2, then f of eta is finite so we plug in eta equals 0. So this is finite at 0. So this is actually what we have. This black one is very nice. It's finite at 0. So if this whole expression is larger than 0, it's more like the black one. If it's been 1 and 2, so we have this here, this becomes a negative here, but this is this here is then positive. But then, so the F is, the density is infinite here. That's like the red one, but it still has a finite. It's still, the area underneath is still finite and can be normalized to 1. So it can be, is a distribution. Okay. But if this whole thing is smaller than 1, then it's actually more in the blue world, and then the station distribution does not exist. Okay, that's how you can characterize, does the station distribution exist or not. You look at the extremes, you get some approximation from a similar thing, and you can see when does this whole thing exist in this sense, viewing this as the barrier we have normally. So let me close and then say a few words about the net worth trap and the volatility paradox and the interaction of the two. So what makes the whole thing work? The whole thing works, and actually it's a new finding, and so the whole thing works, and we're still figuring out the details. So the leverage constraint depresses the drift in the eta. When you're close to 0, the drift is lower. So because you can't take advantage of this high risk premium. You would like to take more leverage, but the leverage constraint doesn't allow you. Okay, so not only is the drift depressed, but the volatility is also depressed. Okay, and then there is what helps on top of it, that the volatility, once the leverage constraint is not binding anymore, the volatility is very high. So I should go back to this picture. So here, this is sigma q, but sigma eta is similar. The volatility is depressed here, and here it's elevated. Okay, so typically we had this volatility paradox. What was the volatility paradox? It says, oh, it actually pushes endogenous volatility up. Okay, and it did. So you see in the red one, so the endogenous volatility is pushed up, and if you lower this fundamental volatility, this endogenous volatility is going up and up and up. But this leverage constraint pushes endogenous volatility up even further in this region, but not in that region. So this goes very steep out there. So the volatility is low, and the risk premium you get because of leverage constraint is also low. That holds you back in. And that's why you can get stuck in this region here. So there's a lot of probability mass here. And I should say, there's of course a steady state somewhere here. And the steady state says, oh, if you have a 0, if you expect shocks, but it happened, there's no shock, you stay in the same eta. Okay, that's what the stochastic steady state is. So there's a mu, the drift is 0, and that's why you're there. But in this region, you can also get stuck. Okay, but it's a different thing. It's like your drift is positive. So I should have had a figure. I think there's a figure somewhere on the slides. The drift is positive, so you still drift out of it. Okay, but you're constantly thrown back. Okay, so even though the drift is positive, you're stuck there too. Okay, and it's because of the skewness of the geometric Brownian. Okay, so because we don't have a clear arithmetic Brownian, and that's why you get stuck there too. Even though there's a positive drift here, you always thrown back. The volatility term is so low, it brings you down there. Okay, so that's all what I want to say. And then finally, I would like to say, if you now look at this micro potential regulation, Basel regulation 1, 2, and 3, when Basel was introduced in the late 80s, so it was introduced in order to some extent also because the Japanese banks took over the world and they levered up too much. And then I said, we need some global regulation to control that. And it was with fixed risk weights and capital requirements. So if you lever up more, it was tighter. And what we can see is that you get low volatility, but you get stuck there. You can't get out of it anymore. Okay, this net worth trap is showing up. And what helps is essentially if you have a relaxed leverage constraint for very low eta values. Okay, then you can get back out again. So you want to have some. So you want to have some leverage constraint which is somehow volatility. So the volatility is very low. You see that volatility is going down as eta is very, very low, but never the leverage constraint is still holding you back. So if your leverage constraint is volatility dependent, then it would allow you to be less tight when the volatility is low. But of course, you need a contemporaneous volatility measure. Typically, the way you measure volatility in the real world is you look at the past, how volatile was it? If it just went through a crisis, very volatile, they get tight volatility measures. So in this model, what this model of course says is if you can measure volatility contemporaneously well, and you have very low eta values, that also means volatility is low. And then you could actually grow up, can relax the leverage constraint and can grow out of it more easily. If you don't do that, if you have a fixed leverage constraint, or you measure the volatility with past data, then you get stuck in this net worth trap. So that's essentially what I wanted to decide. Models properties we wanted to have is like in the normal regime, we're stable around the steady state, not this net worth trap. It's not a steady state, but you get trapped on this. But around the normal steady state, everything is stable. Experts are adequately capitalized. They can absorb these macro shocks. But then this endogenous risk comes from these fire sales, the liquidity spirals. You might have fat tails. And you have this volatility paradox. As the volatility, fundamental volatility goes down, endogenous rises. And even in the limit, so that's a very important point I forgot to put on the slide. If the fundamental volatility goes to zero, what happens then? So sigma goes to zero. Is the volatility gone? That's what you do in all the old traditional macrofinance models. There's no fundamental aggregate shock. But what this model says, and what the AR paper in 2014 says, you let the fundamental volatility go to zero, but the total volatility does not. It stays roughly the same. So if you have a model where you don't allow this volatility to be in the place in the first place, it's totally totally going in the wrong direction. You know? Because you have, it's very different. A model where there could be fundamental volatility and you let it go to zero, and you see the endogenous volatility go up. Even in the limit, as there's almost no fundamental volatility, it's still huge endogenous volatility. Okay, so just setting up a model with not allowing any fundamental volatility and saying, oh, endogenous volatility is also not there, is actually misleading that. And then there's this net worth trap, which comes, this double hump stationary distribution, which comes from the interaction of this volatility being very high in the interim fire sale region, but not in a very low region. So the volatility paradox and the leverage constraint interacting in interesting ways. But there's still more to be worked out and also to relate to different financial regulation and all that, which we haven't done it. Of course, this interaction, leverage constraint, and all this we just discovered in the last few days. Okay, so that's all of what I wanted to say today. Let me switch back to this figure, just for enjoyment of you all.